Hey, welcome back. There have been some developments in the iron market, especially from China's side recently, but the stocks are overall flat or even down, so let's have a look into the 4 largest iron companies on the planet. Really quick, a few things about iron. 1. The commodity basically means China for now. Even if a company doesn't sell directly to China, even though some made ships specifically for that, the country dictates the price. That's because they represent about 70-80% of the demand for iron ore, meaning that any issue in the country, as we saw many times before, results in issues for iron. The recent real estate issues, stimulus, lockdowns and so on had clear effects on the demand and consequently the price. Plus, especially India's and Africa's development could be a very solid catalyst for long-term growth in demand, well above a potential decrease from China. As a parenthesis, don't expect some huge double-digit growth. Huge in this market means like a 4-5% compound annual growth rate. To begin with BHP, this is the largest mining company on the planet overall, with significant exposure to iron and coal, both metallurgical and thermal for now. As you'll see, they are investing especially in copper, nickel and potash, while phasing out of thermal coal gradually. I talked more about potash in this video, and this is simply put a fertilizer that basically gives exposure to all trends benefiting food. Higher population, more access to food and so on, plus vertical agriculture and hydroponics. Something you'll see with all these companies is that they rely on the constant cash inflows from iron because even in negative times they can make money and good valuations to develop other commodities. They can make around 7, 8, 12 to even 25 billion per year. You'll see that this is very similar to Rio and Vale, but there are some essential differences, especially in the portfolio of commodities that they offer. This, for a 135 billion market cap, means a ratio of around 12 today, which isn't terrible, but it's on the higher end for a commodity company. But we see a significant jump in CAPEX lowering the cash flow as the company is developing several projects, phasing out of thermal coal, doing acquisitions and so on. They recently tried to buy Anglo American, especially for the copper operations, but they denied it, and I see that now they are free to bid again since a few weeks ago. Financially, we see a healthy position with a lot of cash and current assets covering the current liabilities and overall not a lot of debt. We see a lot of the liabilities being in provisions, and I don't want to repeat this, so I'll mention it once in the Vale segment since they are related. Anyway, there were some positive developments in that regard recently, and we see 49 billion in equity. That's quite a bit for the current market cap, so you really pay for the company's net assets, but it's true that they make good money. We see them expect higher CAPEX thanks to their investments in what they call future-facing commodities. Again, the big potash project in Canada that should become operational in a couple of years, plus a focus on other commodities with higher potential. In just half a decade, this one can be not only a leading iron company, but also a leader in potash, copper, nickel, which have good potential. They show the expected demand for copper and potash going up about 70% by 2050, which can have significant effects on the commodity cycle, especially if the supply doesn't keep up. The dividend can get very significant, although it's likely to see them cut it again since they plan to invest even more. They currently pay around 5-6%, which isn't terrible, but it's also not the best, as you are about to see. They target a payout ratio of minimum 50%, which is pretty sustainable, and in good years like 2021 and 22, you can get some massive payments. So not bad, and overall a healthy and very profitable way to get some exposure to iron, coal, potash, copper and nickel. You'll see that the main difference between these companies is the package of commodities that you get on top of iron. So in a downside, they are very similar, and I think it would ultimately be about the commodities you want to get. BHP seems to go for the slow and steady vital things, so it's definitely an option to consider, especially for dividends. But a dividend cut is very likely if they ramp up the investments, and the market doesn't seem to be aware until it's already happening, so we might see better prices. Now, Rio Tinto, this is again one of the top iron companies on the planet, being usually the number 2. They produce predominantly iron in Australia, but also invest in developing copper, lithium, aluminum and more. They have a bunch of projects, including a bigger one for iron in Guinea that should become operational in 2025 and reach full production by 2028. They see higher CAPEX in the near future because of that, which can result in a lower cash flow. The stock has been relatively stable and it's almost identical to the price of iron. We see now a, let's say, reversal to the mean and the company getting back to the average cash flow of 8, 9, 10 billion they can make in this environment. Of course, it's going to fluctuate, especially if they have higher CAPEX, but this would put them at a ratio of around 10-12. That's actually the median in the past 10 years and it makes sense given the price of the commodity. This kind of company, and probably all companies in this video, can likely have a positive cash flow in any point of the cycle. So unless they get a ton of debt or something exceptionally bad happens, this should be relatively safe if they manage it right. But still volatile, don't get me wrong. Financially, we see a healthy balance sheet with the current assets well above the current liabilities and not a lot of debt compared to the assets. But on a 100 billion market cap, you get like 57 billion in equity, so you really have to overpay for the assets. With mining companies, there isn't that much they do other than the mining itself and other physical related activities, so what you see on the balance sheet is what you get. If it was a tech company and they had some app or a website which you can't really value and put on the balance sheet because accounting is pretty primitive nowadays, sure, but this isn't the case. It's very on point for this type of company. If you theoretically repay the liabilities with the assets, you are left with 57 billion for which you pay 100 today, and that's it. Now, the dividend is a very attractive 6.7%, meaning around 6.8 billion. The policy is variable based on the profit, and what's very good about them in my opinion is that they don't really do buybacks. 90-something% of the commodity companies I've seen normally do that when they have enough money, and that's when the stock is high, so they overpay. Instead, we see them pay the equivalent of even 14-15% in 2021, for example. So buying this at 8, 9, 10% on average, so 2022 or 2020 or before, has so far been very rewarding from a dividend point of view. But this is currently kind of on the limit, so cutting it could be justified, especially since they could use the recent acquisition as an excuse. They recently bought Arcadium, before I could unfortunately, for around 6.7 billion, making Rio the third largest lithium company on the planet. I looked into Arcadium in a separate video before, but simply put, I think that was one of the best lithium companies on the planet. As you can see, the balance sheet was okay and they had 7.1 billion in equity, so Rio actually bought it below the net asset value. That's quite an incredible deal for Rio, especially since Arcadium had plans to triple or even quadruple the lithium production by the end of the decade. That was going to make it the number 3 lithium company on the planet by production, so if Rio finishes the projects and continues expanding, they could even become the number 1. I mentioned this in the Arcadium video. A company like Rio, BHP and so on could easily afford to buy even the top 2 lithium companies combined with like 1-2 years of cash flows. These iron companies make so much money that they could easily become top players in whatever they want. That, together with the currently stable valuation for Rio and BHP despite the price of iron normalizing, is actually an advantage if they want to use it. And as you are about to see, they are actually developing in copper, nickel, potash, lithium and so on. These are all very nice commodities, and I think that diversifying while keeping a good chunk of the portfolio in iron is not bad at all. So this is overall a good and healthy company from pretty much any point of view. They should have long-term support from India, China and other tailwinds on top of lithium and other metals that could enhance the growth. I think Rio is an overall relatively safe way to get long-term exposure to the commodities they mine. Good financial health, nice cash flows, strong and potentially even better dividends. I think if the price of iron falls a bit more and the company follows, they should be at least with one step in what I would call a buying territory. If you think this looks good now, we are pretty much at the average of the cycle, so nothing exceptional compared to what they can be. Commodity stocks in general are something that I think are very good buys either in the downside of the cycle, obviously, or if they in particular have some unreasonably low prices. Now, Vale, this is a Brazilian company that's one of the leaders in iron, nickel and copper that also has some hydroelectric power plants for their own consumption. They also have operations especially in Canada and Indonesia, which are key countries for many commodities. The cash flow hasn't been amazing in Q2 and 3 due to working capital changes and some other payments that I'll talk about later. They expect a recovery in the following quarters as they had a year ago. It's mostly a matter of receivables increasing and collecting them later in Q4 or next year. Yahoo Finance data is wrong for this year, by the way. It's missing Q2, which was very low. At the current levels of iron, we see them historically making something like 5-7 billion per year, with potential to get into double or triple that much in good and very good times. You'll notice that this level of cash flows is very similar to other big companies in the video, but what sets Vale apart is the market cap. This is all about the location, with the company being from Brazil, who also has some golden shares and interest in Vale. In other words, the market is willing to pay like 1.5 times more for Rio Tinto's cash flow than it does for Vale's because of the risk it associates with Brazil compared to Australia. Sure, that's one factor, but still very important. Thanks to the production cost, Vale is actually able to make more money on a similar revenue, by the way. Is it justified? I don't think so. I don't see South America as this uninvestable place or something, and some of my best investments, or actually the best investments I've ever had, were in South America. Sure, it's higher risk because of the debt and inflation and stuff, but with a good enough margin of safety to account for political changes, it worked out for me. Financially, they are in an okay position, with the current assets almost covering the current liabilities. On the other hand, they barely have debt, and most of what they have to pay is related to decharacterization expenses and provisions for lawsuits, as I'll show in a bit. They plan to increase the total debt a bit, but it's also related to that. We see around 40 billion in equity on a very similar market cap, so they are definitely getting into a very interesting territory. Again, comparing that to Rio or BHP, they are very similar, but the market caps are 2-3 times higher. This is basically a company of a similar size whose assets and production capacity are valued at less than half compared to the others. They are also expanding the copper production, but plan to have about 63-64% iron in the portfolio by 2030 from around 62.3% now. The rest would come especially from copper and nickel, and Vale, by the way, is actually the first or second nickel miner by production on the planet. This can be huge thanks especially to batteries and EVs, and I think copper and nickel should be some of the most important metals in the next decades, so definitely a plus from this point of view. They project a roughly 10% increase in iron production by 2030 thanks to several projects, so not bad on top of the slow and steady demand growth. They also expect the all-in production cost to reach around 50 per ton by 2030, meaning they would likely be profitable or at least break even in pretty much any point of the cycle in the future. The dividend can be massive because the company has a variable policy based on the money they make. The advantage is that they can make so much money for such a small market cap, which can result in 20-30% yields if you buy at a certain price. In 2021, for example, they paid almost $3 as a dividend. That's about a third of the current price, so in good times you really enjoy it. They might cut it in the near future because of the timing of the cash flows, but it's not going to be low forever. If you've seen my previous videos about Vale or BHP, you probably remember the lawsuits regarding the dam collapse from a decade ago. Recently, Brazil reached a settlement that will require the companies to pay around 28 billion in total, spread over 20 years. That's actually not a terrible result for them, and they already had a lot of provisions ready for it. This could have been much worse, and I see that BHP is still facing some massive lawsuit for it. So a significant unknown is now quantifiable, and we know how much they'll have to pay and over how many years, so that's definitely a plus. The market doesn't really seem to care, and it's mostly focusing on the price of iron, but from a business quality point of view, this is a clear improvement. So I think Vale is definitely an interesting option. At this size and with this level of production, margins, price to book around 1, potential for amazing dividends, I'm definitely keeping an eye on them. Currently trading at some of the lowest levels in history, even now that a significant risk is pretty much out, I might open a position relatively soon. I honestly don't even care about the potential price appreciation, the potential dividends alone are really good. If this continues to fall, the yield could even get to something like 6-8% in bad times and even 30-40% in good ones. That's, I guess, the advantage of having a low price to cash flow ratio. You make so much money that you can easily afford to pay something like that. Now, Fortescue, this is the number 4 iron company on the planet, with production operations mainly in Australia, so a literal neighbor of Rio and BHP. As a parenthesis, it's remarkable how much iron can be in that region. I mean, 3 of the top 4 iron companies on the planet rely on the mines in that region for a majority of the production. But that also generally comes with direct dependency on China. We saw recently how a not enthusiastic enough response to the stimulus package resulted in the stocks crashing 5, 10, 15% in a couple of days. They also have a couple of very interesting projects, including green hydrogen plants in the US and Australia that should become operational in 1-2 years. Plus, they are in the early stages of building green ammonia facilities, which I mentioned in a recent video. This can become the future fuel of vessels because it can be a very green and relatively cheap option that burns without emitting CO2. On top of this, they are also kind of a tech company producing these scalable battery modules and investing in many other green technologies. Anyway, more on this in a bit. They can make around 5 billion today, placing them at a ratio of around 8, which is on the lower side in the video. What's impressive is definitely the margin. This company makes around half or even less than half of the revenue the other 3 can make, but the cash flow can be a quarter to even half of it. Financially, we see another healthy position with the current assets well above the current liabilities and a lot of cash. On this cash flow, the debt really shouldn't be an issue, so they can even get more before it becomes a problem, although they are focusing on maintaining it strong. There is close to 20 billion in equity on a roughly 40 billion market cap, so pretty similar to the first two. The dividend can get very significant, currently being at around 10% even if they cut it recently. They paid 70% of the net income, so in good times this can get very good, as we saw. But if they plan to invest more, it's obviously going to cost them, but even half of this would be decent. They seem to have a huge focus on reaching zero emissions quite soon. All companies in the video have to some degree, but this one seems to be particularly focused on reaching what they call a real zero by 2030. No diesel, no gas, solar power, battery trucks, so they don't seem to be messing up. Why it matters is because if you want net zero, which they don't seem to believe in, the low or even zero emissions in the supply chain, including and especially mining, will have an impact. And don't think they do it for nothing. This would come at a premium in the market, and being one of the first big suppliers of zero emission iron would potentially be huge. You know, it's probably the easiest way for a majority of companies that use steel or iron to go for that if they have to reduce emissions. Not to mention the potential government subsidies that you can get, which can justify the demand and also help them directly. So, replacing coal with green hydrogen in steel production, using ammonia as fuel for the carriers, electric trucks, they want to offer the full package of making it green. And indeed, steel and marine transport are very big polluters, so this will eventually happen. The downside, I guess, is, unironically, what if they do it too fast? We see constant issues and barriers in the green targets, and this is, after all, a very politicized subject. A change from left to right can easily add another delay or cut some subsidy, and there goes the demand. So a smaller but very solid company overall, definitely on the cheaper side compared to the others. A small bit of history, this company was in deep trouble about a decade ago. There were a few reasons, but the company's direct dependency on China combined with like 2 or even more times the debt and liquidity issues resulted in them restructuring the debt. I think they are very different today, although still directly depending on China, like a majority of Australian iron companies. But they seem to be much healthier, and the cash plus a year of cash flows covers all the liabilities, so it's much harder to mess it up. They also have the potential of being an acquisition target thanks to the size and also the green focus. They can also do a spin-off and attract a lot more market attention with the green energy and technologies, so there is potential to increase. I'd say this might even be close to a buy for an 8-12% average dividend, but it can always fall, of course. If we get some recession or issues in China, then this would clearly be a strong buy in my opinion. Overall, I think this is definitely an interesting industry. No matter how the fuel and methods used to refine it will change, this is pretty much a must-have in any society. Especially when they combine it with lithium, copper, nickel and so on that have higher potential and can lead to some growth, these companies can have some significant upside if bought at a good price. On top of that, the dividends I think are the main attraction, and in the long term, if bought every once in a while during the downside of the cycle, this can add up to massive payments. But again, I don't think these are something to buy no matter what. I'd much rather buy when the price crashes a lot, they cut the dividend and the market hates them, because that's, in my opinion, the best time to get in. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.